Okay, thank you again for joining us for this edition of WP90X, Wealth Points 90 Minutes of Extraordinary Education. Hopefully, we'll get you guys on your way early. Before we get started, we're going to introduce our speakers. First, Ryan Brusca of Coventry. I'm not going to butcher his bio. I'll let him tell you a little bit about his background. So, Ryan, why don't you go ahead and give us a short intro to who you are?
Sure. I appreciate that. Thanks to WealthPoint, Vince and Ryan and their team for bringing me on here today. So I'm a regional vice president with Coventry. I've been with the firm for close to 20 years now. So I've been through quite a few market cycles, and I'll highlight some of that as we navigate the balance of this presentation. But excited to be in front of this group and hopefully give you guys a little bit of insight on where the life settlement market is today.
And then second is my partner and somebody I had the pleasure of working with directly for about 12 years. And we're still doing some work together, but not as much as we used to. And I miss him because of that. But Vince Brunoforte of WealthPoint. Vince?
Thanks, Ryan. Yes, happy to be here and happy to do a deeper dive into the world of life settlements. And I appreciate both Ryan Baradas for moderating today and Ryan Brusca for joining us with his expertise.
Perfect.
And so with that, we'll go ahead and jump right on in. So the objectives today is understanding life settlements and understanding what the industry is and the opportunity for growth in that market. And we're going to learn about who qualifies, when it should be considered, and then we'll go through some case studies and alternative options, and of course, leave room for questions at the end. So life settlement is the sale of an existing life insurance policy to a third-party investor. You'll also sometimes hear the term viatical settlement, and that's referring to the sale in the situation of the insured having a terminal illness or a chronic illness, often less than 3 years. But settlements or life settlements, that really should be considered anytime there's a key triggering event. So that could be changes in a client's estate plan. If it's business-owned insurance, it could be any changes in the business or the sale of a business. It could be changes in the tax or economic environment in which we're in, or of course, changes in the policy or the product itself, or the health of the insured. But once the sale occurs, the new owner or the investment fund who purchases the policy, they become the owner and the beneficiary. They're responsible for all future premium payments. They take on the risk of any future changes in the policy. And then ultimately, they receive the death benefit. Today, in that sale, the current owner would receive a lump sum check. Once the new owner takes ownership of the policy, ultimately they would collect the death benefit, and to them, there would be taxes on any gain they receive.
As Vince mentioned, the market has been in existence for some time. Historically, we really hang our hat on in the settlement market about how much insurance exists and is lapsed and or surrendered within the senior market. Obviously these numbers are staggering. We've all had clients that have unfortunately, had a change in need with their insurance and maybe a change in their premium tolerance. And so we feel like the market is enormous, the potential that exists. And so through education and forums like this, obviously it gives you guys the opportunity to learn a little bit more about when it can be appropriate. The legal foundation exists and has existed for many, many years via the Supreme Court and the Grisby-Russell case. Not that we have to get into that, but it effectively, establishes that life insurance is property, and you have the property right to assign it to whomever you choose. And that's obviously an extension of, any type of insurance planning that you guys are doing, whether you're pledging policies as collateral or doing any type of key man buy-sell agreements. There's all these reasons why flexibility in life insurance ownership exists, but it also kind of folds into what we do here in the life settlement market. So a little bit of historical background for Coventry, but the market as a whole, specifically because Coventry effectively kind of created this secondary market. Our firm was established in the late 90s. Our founders were in the Coley-Boley business and saw a great opportunity with one of their biggest and best clients who had a large insurance policy that they were going to lapse. And so through, identifying a situation that would benefit from a secondary market, they effectively created the robust market that exists today. Obviously there's a lot of reasons why people take out life insurance, and there's a lot of reasons why individuals, especially in the high net worth arena, their needs change, evolve, and shift. And so the secondary market provides opportunities and exit strategies from those life insurance policies. There's a very competitive and robust market that exists today. In the early years, it was just a few resources that were out there buying. It was predominantly private money, but with Coventry growing the market to where it is today, we've bridged capital markets and brought in more and more institutional money into the space, which is now the driving force of the market. And so you'll see a lot of discussions about who's buying, how we're buying, and who's the end, the end portfolio going to go to. So Coventry does buy a lot of insurance for their balance sheet, but we partner with numerous institutional capital resources from hedge funds, pension funds, family offices. There's just a lot of investor appetite, just given where markets are today. So I would say that, and I'm sure Vince could echo this, it's probably one of the healthiest markets that we've seen in decades. The next slide, I think, is ecosystem, correct? There we go.
Yep.
So we'll talk a little bit about like who the parties are that are involved in the transaction, from top to bottom, right? If you've got a policy that looks like it could be a potential opportunity, you've got three parties to that transaction if they do ultimately move forward with a life settlement. You've got the policy owner, which again could be anybody from an individual, more likely in your case, a trust or an LLP or some type of corporation. You've got the individual that's the insured, the underlying asset that we have to underwrite, and then you've got the beneficiary of the policy. Those three parties are always going to be a part of the transaction and discussion. WealthPoint is uniquely positioned as kind of the front and center in identifying opportunities and being a valuable resource for everyone in the room to run situations by to see if it would be a fit. And then you've got groups like Coventry that WealthPoint will go to screen opportunities, talk to them about situations, and whether or not they're going to be a fit for a life settlement.
Ryan?
Yes, go ahead.
Quick question. Is
Sure.
Coventry, as a provider, do you function both as a connector to outside funds that are purchasing these and as a purchaser yourselves, or how do you guys play in that space?
Sure. It's a great question, and I think it's been an evolution, right? But I think at the heart, Coventry has to have their provider license as a buyer of life insurance policies. We aggregate portfolios for our own balance sheet, and we also are building perpetually portfolios for capital resources that we work with. So when I say we bridge the capital markets, for a long time, we aggregated over, I think it was close to $5 billion of life insurance for AIG and one of their subsidiaries. This was going into 2008, probably starting in around 2003 to 4, all the way up until 2012. So I know it's a long time back in the rear view, but that's the type of capital resources that we partner with. Your Apollos, your big hedge funds, they drive a lot of the innovation and appetite for this asset class. And so it's a little bit of everything. What we have right now, we've probably got close to $2 billion on our balance sheet of life insurance policies. And we'll get into, why we have such a large balance sheet, predominantly based on the broadness of our parameters.
Gotcha. Thank you.
Yeah, of course.
And Ryan, also, I understand that we'll get a bit into this, but the IRRs that these funds are pursuing, that's going to depend on the different product types, whether it's a guaranteed policy or whether it's a current assumption universal life policy. And that target range is somewhere between 8 and 14%. Is that correct?
Yeah, I think that's pretty fair. I mean, I think if you think of the broadness of the space, and this is a good slide to talk about it, we buy on life expectancies all the way out to 20 years, right? And so that's a pretty long-term investment horizon. And, a 20-year life expectancy could mean a pretty healthy individual in their 70s, or it could be an unhealthy individual in their 50s, right? It's all about where life expectancy and the studies that we do on mortality come back. So if you have a very short life expectancy and the valuation is very strong, it's a very large offer for a policy on a short life expectancy, you can imagine that funds and Coventry would go down to a lower IRR because, it's the inevitables right around the corner. versus something you're waiting 20 years on. So you might look for a higher IRR, like a 15 to 18% IRR, just because of the cost of capital and that long-term investment horizon. So
something I've appreciated working with you, and we know when we go through our financial modeling, one of the options that we always consider for clients is them keeping the policy for themselves, right? If it's a good investment for somebody else, maybe a good investment for the family group, and showing them what that is, and then ultimately letting them make that decision. But I know that you've been very transparent in, how that rate of return would work as far as what you guys are looking to achieve and the tail risk on the different products. So I thought that's a good point.
Absolutely. And to that end, I feel like WealthPoint does a phenomenal job at assessing the situation and being able to present, all options, when situations do arise. And I think that's critical, especially with high net worth families. So jumping back into like who qualifies for these opportunities, we do say that, 65 plus is really kind of the sweet spot for where the market begins. Obviously, if you think about the market in totality, we are working predominantly within the senior market. So, we're looking at folks that are in that distribution phase of their life and are probably, thinking about a lot of different things when it comes to their life insurance holdings. You buy a life insurance policy 20 years ago, estate planning was different yesterday than it is today. And so there's a lot of reasons to be discussing policy valuation and policy review, which is the crux of this presentation. But, health change is going to be a prerequisite the younger you are, right? That's going to really drive whether or not there's going to be value for your insurance policy if you're under the age of 70. The market does thin out. You've probably seen this, Vince, in our dialogue over the years. Funds are just less interested in risk and mortality risk on individuals under the age of 70. That said, Coventry's very, very comfortable. If you talk to our CEO, he loves his experience on younger insureds with health impairments. I just think we have a good understanding and a good grasp of how life insurance functions, and then obviously a good grasp on mortality. I think a lot of times the question will arise, what is the ideal life insurance? And I always say that our business and our market was built on underfunded life insurance, especially universal life. How life insurance has been sold over the last 30 plus years has evolved. In the high net worth arena, it is a lot different than the general public and how it's sold, because in your world, in WealthPoint's world, and everyone on this call, life insurance reviews are really critical. Doing, quarterly or annual reviews of insurance holdings is paramount, especially for larger life insurance policies. And that's critical because we have always talked about why that's important and how it can lead to a conversation or a proactive a review of an insurance policy. Whether a life settlement is the primary, outcome is irrelevant. I think it's just the conversation piece and the capabilities that WealthPoint has. So talking about what's opportunistic, larger face amount is always going to be, a primary driver. Our average face amount over the years purchased is probably 2.5 million. And when you're purchasing, over $1.5 billion of life insurance each year, it just shows you the magnitude of the type of insurance that we're able to purchase. We don't have any face limits. I think probably 3 years ago, I did a $200 million insurance portfolio review. So it's not out of the question that, very large estates can come to the market and see some value and some real solutions stemming from it.
Ryan, what changed over the last 10 or 15 years? Because I remember there was a time where it was more ideal if they were smaller policies, and I would see even people selling insurance with the intention of selling the product itself with the intention on settling it later, and they would break it up into $5 to $10 million chunks. But now, are funders not worried about that concentrated risk and single lives because of the size of the market? What's happened?
Yeah, that's a great question and a good tangent. You're right. I think there was a lot of manufactured business that came to our market probably between 2005 and 2015. And when I say manufactured business, it was premium financed. It was probably purchased with the idea that it could be sold or should be sold or will be sold. And so as a provider, we have to do a lot of diligence on that. And so we've always, prided ourselves in the ability to purchase large face amount, and we don't shy away from it. But you're right, the investor appetite waned a little bit because there was, a little bit of nerves based on policy origination. A lot of the STOLI, for those that aren't familiar, STOLI is stranger originated life insurance. That was a big gray area of the market. And so, there was a lot of sophisticated vehicles put together where, the beneficial interest in an insurance policy was sold off before the policy even, hit a 2-year mark. And so, yes, that gray area definitely put a, a dent in, appetite from a lot of funds. But you're seeing that's all but gone at this point in time. And so now you're seeing real traditional life insurance, traditional planning come to the market. And, that's a big driver for why funds are more comfortable buying large face amount. So good question. And then we're going to jump into some high level industry facts. We talk a lot about the potential that exists in the market. We're talking billions and billions of dollars of potential life insurance that could benefit. And each year, it's just a small fraction of what's out there that the secondary market purchases. Vince and I were talking about this the other day. On the high end, you're looking at upwards of, the high 3,000 to 4,000 policies sold in any given year. And Coventry has a 50% market share and has for years. We consistently hold the mark anywhere between 48 and like 53% of market share. And we still feel like we're not putting a dent in the amount of insurance that potentially could be sold. And then when you couple it with the amount of insurance that's actually lapsed or surrendered, it's disheartening. And so, educational forums like this are really helpful and meaningful to help drive knowledge and really kind of drive home where the opportunity exists. One of the things that we'll touch on, and it'll probably come up a couple more times, Vince, through this is tax treatment. And I think it's really critical to talk about how it's cleaned itself up a little bit. It used to be a self-reported transaction in the early years, so it created a lot of confusion, especially for sophisticated families, on how they were going to get the information to report this and what the best course of action is. And the 2017 Tax Cuts and Jobs Act cleaned that up. It's now a 1099 transaction. As the buyer, we are we're required to provide a 1099 for the sale price, but we're also required to notify the insurance carrier that the policy is being sold, and they are to furnish the seller a 1099 for the cost basis into the insurance policy. And now you've got a really easy 1099 dueling transaction where a CPA can look at the numbers and say, well, this is pretty self-explanatory. The code's real clean and easy. So I think that's really important because it just lends credence to what's being done in the market, and it makes it a little bit more palatable conversation. So we've talked about it a few times. Market potential is certainly there. So think about your client base, think about what's in your book, and your front and center with your clients about their life insurance holdings, and if there's an opportunity to be evaluating their life insurance policy. There's 150 billion of insurance that's owned by seniors that lapses each year, and those are probably situations where either the subject wasn't broached or it just didn't seem like it was a fit or an opportunity. And I think that's where WealthPoint can really kind of guide you into identifying opportunity.
Yeah, Ryan, can you go through the actual breakdown of taxes? Maybe you and Vince can speak to a little bit about that, because I understand there's been some major reform and there's clear rules around this, but you mentioned basis and gain and what have you. What is taxable to the seller of the policy? And then a lot of clients wonder how the asset is taxed to the purchaser as well.
Sure. Vince, you want to take the front end? I'll take the back end.
Sure. Yeah. So for a policy owner, their cost basis is going to be the premiums they've paid into the policy, less any withdrawals or deduction or distribution. So their premiums paid in. Now, if there is gain already in the policy, like if the cash value in the policy is higher than the cost basis at the time the policy is sold, that portion is treated as ordinary income. But everything above that is going to be treated as capital gains. And so the benefit, one of the benefits of the Tax Cuts and Jobs Act is that prior to that, there would be a deduction of cost basis of the insurance charges or the benefit of having had the insurance. And Ryan, I think that's what you're speaking to, which made it a little bit difficult for reporting purposes of figuring out exactly how much that reduction to the cost basis is. With the Tax Cuts and Jobs Act, that eliminated that. So there, you don't have a reduction to your basis for the benefit of having had the insurance. So it just makes the calculation much easier. Ultimately, what it did is it made it less of a tax consequence and put more money in the pocket of the insured or the owner of the policy. And then from your side,
Yeah, so from our side, because there is a transfer for value, we do have taxation. We lose that tax-free advantage of the life insurance. So, it's obviously something that needs to be factored in when we evaluate an insurance policy, for sure. Yeah, like Vince said, it's a really cut and dry transaction from a taxation perspective. Now, you only get into complicated scenarios when you do have gain in your policy. There's potential to discuss tax loss when a policy is sold for less than basis. And Vince, you and I have talked about some opinion letters that are floating around out there that Coventry has been involved with. But that may add to, another layer of sophistication, especially when you're looking at, a more dynamic scenario.
Yeah. And Ryan, I know that, you and I meet frequently when we come across some of these opportunities, and it continually reminds me of how infrequent this topic gets discussed. We'll get hired to do an independent review of an existing portfolio of insurance. And if we bring up the topic of life settlements, we often hear, I've heard that before, but I've never seen it. Tell me a little bit more about it. And I think that just goes back to what you were mentioning before of really a large opportunity in the marketplace that does not get discussed as frequently. And because of that, some opportunities get missed. And so
Sure.
That's the goal here today. So next, we're going to get into some case studies. We've got a few different examples showing a few strategies that are going to help with understanding where it fits and how it works best for clients.
When we go through some of these case studies, I want everyone to keep in mind that, a lot of these case studies were really born from just a policy review, or a simple policy valuation, a needs-based valuation with a client. So, the settlement's not always going to be the forefront solution, but I think it's really critical to layer in this option, either to create a benchmark for evaluation. This policy here and the next one are pretty similar in face amount, close in age as well. But both of these were born and out of a review of an insurance policy that probably occurred 5 years prior. And maybe it was an annualized, check-in with the family. But this was a situation where we had two individuals that were in reasonably good health, 79 male, 77 female. A lot of times when we review insurance, we talk about what's the background, why are they thinking of making a change for the insurance? And in this case, they were looking to at least reduce or eliminate their ongoing premiums. And, they still wanted to retain some coverage. And so, face reductions are always part of the conversation. But, Vince and I always say, let's hit the pause button at that junction, because before we make a change as it's a solidified change when you reduce the face amount. You're never going to get that death benefit back that you relinquish to the insurance carrier by reducing it. And so in doing the review, we came to the conclusion, based on our underwriting and evaluation of the policy, that we can provide the family with $3.5 million of retained benefit, effectively eliminating their ongoing premium. On this one, I think their basis was close to just over $4 million. And they were slated to, based on the premium projections and their view on longevity, to pay an additional $5 million to carry this coverage into their 90s. And yeah, most families will take a close look at that and try to decipher if that's a good use of their capital. And in this case, they decided to move forward with a retained benefit option. Now, what we're doing effectively is allowing them to assign a beneficiary of their choosing and eliminate their ongoing need to pay premiums, where we shoulder that. And, this was a great case design where the family kind of solved a couple issues, lowering or completely eliminating their premium, but also, retaining some protection.
What are some of the reasons that people are considering getting rid of, other than cash flow constraints,
You know,
getting rid of a policy of this magnitude? Is
I
I
think
know
it's,
sometimes they're oversold and the people
yeah.
buy more than what they actually need, and that's part of the issue. But what else?
Yeah, I think a lot of what we see is just the estate planning landscape. I think, a lot of these insurance policies, people spend down their estates. There's sophisticated planning that goes on behind the scenes that you guys are well involved with, and just needs shift. And look, sophisticated families understand if they have a good asset, they should keep it, right? And if they have the means, they should keep it. But I think at the end of the day, premium fatigue can set in for some families, and a lot of times there's dynamics at play that aren't necessarily on the surface, right? You've got a wealthy family that has, multiple children. And so there's dynamics at play that can really drive decisions. And I think in this instance, they really wanted to keep some flowing to their kids, but they didn't really feel like they needed the full $12 million just based on some of the planning that they had set forth and taken care of in the last couple of years. But, they took the policies out when they were in their early 60s, and their basis was already climbing, and they knew that they were at a crossroads where they would need to shift their funding strategy. I think they were paying close to 280 a year, and then had to really kind of ratchet down and decipher, if they did have longevity on their side, which they did from looking at their parents, and trying to plan accordingly. They needed to up the ante on their premium. And so this was just, one of those situations where it was a good fit. Some families are more interested in getting cash, which, the next slide will go through, on case study 2. If you want to flip to that one. This was another scenario in which, it was a one where, again, it's a question of whether or not they want to continue the coverage as it's currently stood. And so you had an 82-year-old male who was in excellent health. And so what's interesting about this case, and we didn't touch on it earlier because it's a fairly new and dynamic solution from Coventry's perspective, but this is our enhanced cash value program, which is our non-medically underwritten program targeting healthy individuals. And so when the advisor reached out to discuss this case, he said, I've got an 82-year-old, he's got this $12 million policy. There is significant family dynamics at play where you've got a tug of war between, I think there was 6 siblings. On one side, we value the insurance. On the other side, we don't want to continue to gift premiums and kind of, have the children start to pick up the burden of the premium. And so we knew it was dynamic. We also knew that they were hypersensitive to releasing medical information. And so when we looked at it on the surface, we felt like it was going to be a good fit for our non-medically underwritten program. And so when we went through our process, and I won't get into the weeds on what our enhanced cash value program is, and Vince can talk about it as well, but it is heavily tied to annuities. We are using annuities to fund the insurance. So it's a special purpose vehicle. But the idea and the takeaway is that we really are looking for healthy individuals. We're not looking for health arbitrage. We're not looking for mortality profiles that fit the traditional mold. And this case was a great example because, as you'll see through the outcomes, it gave a lot of flexibility in how the family approached the situation and their decision-making process. So they were both standard at issue. Unfortunately, the wife had predeceased the male probably 3 to 4 years prior. And in that time frame, the premiums had gone on pause. They took a break from the premiums, and the cash value was starting to diminish a little bit. And they started running reprojections as they were having family conversations about who's going to pick up the premium. And effectively, the grantor of the trust was like, I'm not going to continue to pay this and fund it. We can let the cash value ride out. But the agent, obviously said that was not the best way to move forward with this. And so they brought the policy to market and did the valuation. So at first glance, we were able to provide a cash offer. So the cash value in the contract, as you can see, is like a shade over 1.2, almost 1.3 million. Their basis was 1.4. So it was funded quite well, and they still had some good equity growth. But again, as they were running no pays, they saw that there was going to be a big problem in the next 3 to 5 years. So it was almost getting out in front of an issue, which I think was real critical in this case. So we valued it at a cash offer of 3.4 million. And the family deliberated, discussed. They weren't sure what they wanted to do. They actually put it on pause for a couple months and said they were going to probably continue funding it. And then at that point in time, we paused and started to look at other options. And in doing so, we really learned that, effectively a family of 6 was contemplating paying the premiums. And so we went back to the drawing board and structured a retained benefit option. And then in doing so, we came to the table with a $6 million retained benefit, similar to the previous case study. So the family now had 2 options that they could explore and deliberate on. And ultimately, the end result was taking the $6 million of retained benefit. Yeah, look, the process doesn't happen overnight, right? It takes time, and there are sensitivities that everyone should be aware of when life settlement offers are made, right? Because you have, cost of capital being a critical component, and you have annuity rates in these enhanced cash values. The offers don't sit out in perpetuity, and so we were cognizant of the client, and so was the agent. But they were also mindful of the fact that, when we go through this process, if it is going to take a little bit longer to make a decision, sometimes the pause button needs to be hit and we need to go back and reevaluate. And so thankfully, the options remain fairly stable. But, as we're all aware, treasuries are moving and interest rates are, kind of up and down at this stage. And so it creates, I wouldn't call it volatility, but it just creates, something we need to be mindful of.
And Ryan, it is that annuity structure which allows policies on healthier insureds to be sold, because in those cases, medical records aren't even necessary, right? They're buying insurance policies simply based off the age and the gender of the insured, and they're able to acquire an annuity which funds the premiums and ultimately pays a lump sum still to the owner of the policy today.
That's correct. Yeah, and it's it's a strategy that we've deployed for years and years and years, and until we finally exited the extreme low interest rate environment we had seen ourselves in for the better part of a decade. The annuity rates just weren't strong enough for it to be a strategy that we could deploy. I mean, our closing documents across the country have always had a hedging option within in the closing documents where we reserve the right to take out a SPIA to use it as a hedge on the premium for an insurance policy. So it's something that we've looked at, and for those that have been in the industry for a long time, annuity arbitrage was always a great play. Back in the 2000s, and there was a lot of sophisticated advisors that saw opportunities there, and so tying an annuity to an insurance policy is a wonderful thing, and thankfully we've got an extensive amount of capital committed to this program. And we can deep dive into what the program looks like. Vince has some information on it as well, but it is a couple key points. It's aimed at healthy individuals. Right now, it's being marketed for 65 plus. Obviously, when you get down below 70, it becomes really tricky because a lot of things need to click and it needs to make sense at that junction. But I could go down a path on a couple case studies just off the top of my head where we've made cases work on younger individuals.
Yeah, one of the examples we'll go through in a sec actually had that as a component. But before we get to that example, Ryan, I'd like you to touch on term conversion, because I know this is an area that a lot of people are unaware of, how term policies could actually be considered for life settlements.
Sure, absolutely. So term insurance, forever has been, written for obvious reasons. It's low cost. It's simple. It's pure life insurance, and in everyone's world here, jumbo life insurance for key man individuals or buy-sell agreements is, where we see a lot of opportunity. In this instance, this was a 72-year-old male who had an expiring term policy, was paying about $24,000. Or no, excuse me, he wasn't paying 24, but he was about he was on the precipice of his conversion deadline. And it was identified as an opportunity because he wasn't going to convert the policy. It was just too costly for him to convert. And so we did our life expectancy studies, which we haven't really got into the nitty gritty on what it looks like, but we can. But we went through our underwriting process. His life expectancy was somewhere just a shade over 10 years. And he was in reasonably good health, considering, he's got a couple issues that were controlled with medications like hypertension and diabetes. But obviously this was a conversion that he wasn't going to do. And I think that's the real key with term policies and convertibility is the carrier landscape has shifted. Most insurance carriers that were ultra competitive in the term arena 20 years ago have adversely changed their products for conversion. So it's really challenging in your world to position the idea of converting when the product selection is so limiting. That said, those policies, if there is no conversion happening between the advisor and the client, should be brought to the settlement marketplace, because that is the alternative to a conversion. And we are doing a lot of split and converts where maybe a client is going to convert a portion, but they're going to also sell a portion. It's a great strategy. And so this was one where the term served its purpose. The conversion was too expensive, and we ended up purchasing the insurance for $50,000 plus reimbursement of the premium to come out of pocket. We can also, as part of our closing, front the premium to convert, but that's a different conversation. Obviously, all these case studies are commissionable events, but I think the critical part with term is identifying when a conversion deadline is looming. A lot of times you can look at your book and your client base and see that you might have a large term policy that's coming due for conversion within the next 12 to 18 months. And that's a trigger to start a conversation with WealthPoint as to whether or not it's a viable opportunity to convert, look at some options there. But then also if there's any alternative strategies, like delving into the settlement market for those. And the nice thing is, go ahead.
Ryan, if we have a client, for instance, they have a $10 million policy, it's getting to the end of the conversion window, but they're only looking to convert 5 million, let the other 5 million lapse, bring it to the settlement market, because they may be able to convert it and sell the other portion, the portion that they were just going to let lapse at the end of the level term period.
Absolutely. I can't tell you how many times it was identified, and they were almost at the precipice of, you look at these conversion apps, it's like convert a portion and the balance gets lapsed, and it's just you've got to pause, because think about it. I mean, you could have a 72-year-old with a $10 million insurance policy. There's probably a $500,000 of target there, right? I'm doing one right now. It's $10 million. And they were on the precipice of lapsing both of them. They're not going to convert both of them. They have adequate coverage outside of these, but the advisor is going to make close to $500,000 in target on the sale. So we always look at it, and I think WealthPoint probably echoes this. How do we complement, right? How do we create a case design? How do we turn something that is going to fall off the books, whether it's a term conversion or a lapse or a surrender? How do we turn that into something positive and a positive experience for a client? And that's where, just being mindful and not shying away, because, we screen policies all day, Vince and I, and there will be opportunities where we just say it's probably not going to be a fit. We're not here to spin anybody's wheels. We want to make sure that if we're going to pursue something, we have a good idea of what the outcome will look like. And, we recognize that it's your client and an extension of everyone's practice that we're bringing this solution up.
Yeah, we always make sure that when we get brought in to review an outside portfolio that involves term insurance, that the advisor and the clients understand the term duration can be different, and often is, from what the term conversion is. And you could have a 20-year term, but the conversion privilege may end at age 65 or age 70 or some shorter duration of time. So it's important that we highlight that for the advisor team and the client, for them to understand, is there a conversion privilege? If there is, what does that look like? And what options need to be shown there. The last life settlement example here is a project that we got brought into, and we received a phone call from the wealth advisor saying their client has this insurance. It's owned in an irrevocable life insurance trust. There's no need for the insurance anymore. And the initial action was going to be just surrender the policies for the cash surrender value, which was about $600,000. And we said, okay, well, let's pause on that really quick. Let's dive into the case a little bit and learn a little bit about the family group. And the advisor was telling us about how this insured is extremely healthy. He was an older gentleman, but he woke up at 4 a.m. every day. He walked 5 miles. He could do push-ups and sit-ups, extremely active, extremely healthy. And so we said, well, let us do a little bit of digging. So we went and we explored that annuity market, the market for healthy insureds, where they don't even need medical records. So within a couple of days, we got an answer back and said, we found out they could provide an offer of 1.1 million to the family for this insurance. So right away, we found an opportunity to increase by about $500,000 what the family would be receiving through the life settlement market. And again, that was that annuity option where there would be no underwriting, no medical records. It would be a very fast process to closing, and it would result in this family group getting an extra $500,000. But we took it a step further. We said, would you mind talking to the advisor? We said, would you mind if we had just a phone call with the insured to learn a little bit about their health? We understand their healthy habits and healthy lifestyles, but sometimes there's more under the hood than what appears to be. Client said, yep, that's fine. The advisor was fine with it. So we had a phone call with our internal underwriting team, who are experts in medical underwriting. And through that phone call, we found out that there were some other concerns and some other issues. So we said, well, if we could just take a couple of weeks to dive into this, there may be more to consider. And so we did. They gave us the time. We ordered medical records. Our internal team reviewed that and audited it. And we went out to the marketplace. And what we found is that there were health impairments. And there were health impairments that were quite significant. And even though the insured was very active and healthy, these were things that ultimately increased the offer to the family group. And so we'll go through a little bit there, but there was a few options that we wanted to consider here. So you had two different policies. You had two policies. They were identical. They were both owned in the trust, and they were underfunded. And in order to continue the policies out to age 105, it would require $234,000 a year of premium. This was a problem because what was going on, the insured was gifting this money to the trust for the trust to pay the premium, but the financial advisor explained how he could no longer afford to continue making those gifts and have a high probability of living the rest of his life and his lifestyle. So what would have to have happened is the beneficiaries would have to either come out of pocket, or we'd have to have some sort of a reduction in premium. So we wanted to show a few different strategies to the family group, and we'll show that here on the next slide. Yes, Ryan?
Real quick, a lot of this, the reason why he couldn't afford it was because of what Ryan talked about earlier. They had gone through and had some really successful estate planning transactions. And so they had transferred assets to the next generation, and he was living on what he could have, effectively financing his own lifestyle. But this additional $234,000 was not going to work. Well, oftentimes when we shift assets to the next generation and there are many kids, say 4 kids, that gets divided up amongst 4 kids, what are they doing? They're relying upon that wealth to live on. The last thing they want to do is reduce their cash flow by 1/4 of $234,000 and compromise their lifestyle. And so that was what was tugging at them. But at the same respect, what Vince said, if this is a good enough investment for a fund that's targeting a, say, 10 to 18% IRR, is it a good investment for the family group? And now you're dealing with, do I want to make a good investment, or do I want to enjoy the cash flow and enjoy my life? And that's really the dynamic that was at play for Next Gen.
Yep, good point.
Okay.
And so some strategies that we explored, we could sell one of the policies and use those proceeds to fund the second policy. We could sell both policies. So going through the lines here, the bottom line here is surrender both policies, which we proved was not the best option. We could sell both policies today and invest that money in a brokerage account. We knew that paying no more premiums was not going to be a viable option because both policies would lapse between 90 and 91. And this, for this insured, his life expectancy was beyond that. This yellow line here showed selling one policy to fund the second policy. And ultimately that keep one of the policies between age 95 and 96. But now you have the risk of changes in insurance charges, or, you could have other issues. And ultimately, given the options here, what the family decided to do is they said, we would rather sell both policies today, have a guaranteed, return on the investment, and have that cash today to enjoy while dad is alive and while we could do activities together as a family, and not be put in this position where we're counting on dad passing away by a certain time, or if he lives beyond that, there could be financial strain to the kids, to the beneficiaries. So ultimately, they did decide to sell both policies. The last piece that I want to get in here is a discussion about the fee disclosure, because this is something that gets brought up to us about, how do we get compensated, and how is commission structured or compensation structured in the context of life settlements. Well, unlike traditional life insurance, where a certain fee comes from the insurance company, the fee here is something where the broker chooses. And we wanted something that's more mathematical, and looking at what the traditional market generates. They either will take a third of the value created. This is probably the most common compensation structure. So taking a look at what was the value created. Well, in the context of the case here, you had $598,000 of cash already in the policy, but we obtained a value or a gross offer for the family group of $1.94 million. So 1/3 of that value created would be $447,000. Another common measuring stick in the settlement market is taking.
So the family group's only getting $1.5 million, just under $1.5 million in that example.
Correct.
Of the $1,940,000.
Correct.
Sorry.
Another common measuring stick is just taking 20% of the gross offer. The gross offer was 1.94, so 20% of that would be $388,000. Or another common measuring stick is 6% of the face amount. It's a $5 million total face amount, so there's two policies of $2.5 million. So 6% of that is $300,000. The reason why there's three different measuring sticks is you can have, every policy is different. You might have some policies that are high in cash value, so the value created doesn't provide enough compensation in the agent's mind, and so they'll choose one of these other measuring sticks. What we prefer to do is take a look at all three of them and see what the average compensation is for that. And in this case, average compensation is $378,000. Well, like we do with all the work that we do, we're going to apply a discount to that, because we get brought in by professional advisors across the country, and they bring us in to work on their best and most trusted client projects. And they understand that we're going to be transparent in how we work, and we want to provide fair value as well. And so we apply a discount on all the work that we do. And in this case, we provided a 37% discount. And the compensation we received in this case was $240,000. So this added about 9% to the amount that the trust ultimately receives, which is a big improvement for them. And of course, we went through all of this with the family as we were outlining the different strategies, and they were quite happy to move forward with selling both policies. So we've talked a lot about life settlements. What are life settlements? When should they be considered? And life settlement industry it's a tremendous opportunity and a tremendous strategy for clients in certain cases, but we understand that it doesn't always work. And so when we get brought in to audit existing portfolios of insurance, the life settlement option is going to be something that we consider, but it's just one option of many others. And I'll talk a little bit about what some of those other options are. We spent the majority of the time on the life settlements, but it's important to know, especially for trustees and fiduciaries, what other options exist when you're looking at an existing policy or portfolio of policies. So depending on, again, those changes that we've talked about for a client, it could be changes in their estate plan, it could be changes in exemption limits, in taxes, it could be changes in their business. There's really 10 different categories. Life settlements is one of them, but other categories that we're going to talk about here. So staying the course, understanding if you don't do anything, if you make no changes, what does it look like on a go-forward basis? Or a policy restructure. So that's making changes to the existing policy, and you can make changes with underlying investments or how the policy is set up. You can also do a policy replacement. So a Section 1035 exchange is a section in the code where you can move from one existing policy to a different policy, potentially an improvement or a policy that's based off different insurance charges and ultimately a benefit to the client. You can take a premium holiday, which was something that Ryan Brusca mentioned before, where you just stop paying premiums for a period of time. If there's big changes going on in the client's life or in the tax or economic environment, you understand first what would happen by ordering illustrations, but you can see about taking a premium holiday and then seeing what increased premiums would be in the future, or a death benefit reduction. So again, we looked at an example of having a death benefit reduction versus selling a portion of a death benefit. And so contemplating what is a better outcome for a client. A reduced paid up. So again, that would be deciding, I don't want to pay any more premiums. I'm going to reduce the death benefit all the way down so that the policy could stay in force forever without any more out-of-pocket cash flow. You could surrender the policy, which of course is typically the first route people consider, and what we always advise our advisor partners and clients is, before you make any permanent decision, let us have a conversation about the client and the goals and objectives, and we'll review it, because once you make that permanent decision, it cannot be undone. Cost basis recovery is a strategy that we'll give an example of, or you can always make a gift to charity and look at what are the advantages of that. In any of these, there's going to be a variety of different, subtypes. So we're going to look at the high level examples here, but understand there's different variations of all of these. So policy restructure. So there's ways that you can improve an existing policy, and it goes undiscussed because oftentimes there's no compensation involved with that to any insurance agent that's getting brought in. But it's important for advisors to understand how you can improve an existing client's portfolio without changing much. So in the example here, we had a client who we got brought in to do the review. They bought a policy in the past, and they had a $6 million death benefit with John Hancock. They had a standard underwriting rating. And as we were looking into it, we learned a little bit about the client's health, why they got that rating. And we suggested an informal underwriting process where we just gather current medical records, we evaluate their current medical standing, and we'll go and explore that informally with a handful of insurance companies. And in that process, what we found is the client's actually receiving best ratings or super preferred underwriting ratings from many carriers across the board, including their existing carrier. The reason why a client might have a standard in the past and have an improvement is there's certain impairments which previously were viewed negatively, and today they're not. Sleep apnea is one of them, where in the past, sleep apnea was viewed in a quite negative light, but today, with proper utilization of a CPAP device, you can have clients achieve preferred ratings even with that. And there's other instances too, where, like we talked about, an external 1035 exchange, you can actually do an internal 1035 exchange, where you can move from an existing product at a company to their newest version at that same company. And that newer version product may just have lower insurance charges and ultimately be a better solution for the client. And with a combination of a few of these things, you can put a client in a much better position than what they were in prior. So in this example, we got brought in to review a client's existing portfolio. And the end result is we were able to take their current $6 million policy, which had a $112,000 annual outlay, and reduce that down to $81,000 a year. And we're not changing the insurance company. We're not changing the risk profile. We still have a current assumption product. But ultimately, how this occurred is we got an improvement in their underwriting rating, and we're able to move them to a newer product within that same company, which had lower insurance charges.
So the rating went from a standard non-tobacco to a super preferred non-tobacco.
Correct.
And you're also in a more competitively priced product at the same time.
Correct. And again, this often doesn't get discussed because you're not selling a new product. So there's no compensation being paid. And this is often the reason why the first instinct is, hey, you're paying $112,000 a year. Let me show you these other insurance companies where the premiums can be even lower. And that's not the right way to go about it. The right way to go about it would say, you're paying $112,000. We can make all these improvements to your existing portfolio, and we can bring it down to $81,000. Now, if we take the $81,000 to the marketplace and find better alternatives, then those could be discussed. But we got to compare it to the $81,000, not to the $112,000.
Perfect.
So next is death benefit reduction, and this is pretty straightforward. We had showed a previous discussion of this, but we had a client who had a $15 million policy, and there could be many reasons why a client decides they don't need as much coverage anymore. Again, changes in lifetime exemptions, changes ultimately in estate tax liquidity needs, or thoughts and feelings about the beneficiaries, or cash flow restraints that a client might have. As discussed before, when you reduce the death benefit, that's a permanent change. So before doing that, we would explore whether or not the reduced portion could be sold and ultimately provide more to the family. But if it can't, then you understand that it could be just reduced inside the policy itself, which ultimately is going to reduce the premium required to keep the policy all the way in force. So on this $15 million portfolio for the client, we showed 3 different examples, reducing it by $2.5 million, a reduction of $5 million, or a reduction of $7.5 million. And then you can see the corresponding change in the premium going down to $197,000 a year, or $126,000, or all the way down to $55,000 a year.
What was the original premium that the family was paying and they were trying to reduce?
The original premium, so the policy was issued in 2007, and the original premium was $268,000.
Gotcha. And so they can go from 268 to 197.
Correct. 268 to 197, or to 126, or to 55.
Gotcha. Thank you.
And then the last example here, and this is kind of a unique one that we worked on, is a cost basis recovery strategy. So there's often cases where you have an existing life insurance portfolio, you've paid premiums in, you've got your cost basis in that, but your cash value in the insurance policy may be quite a bit less, or in other cases it may be zero. You may have funded a guaranteed universal life policy and then ultimately decided that you no longer needed that coverage. Well, if you were to surrender the policy, the life insurance policy, that's a non-deductible loss. So a way that you can preserve that cost basis would be to do a 1035 exchange to an annuity. So you are able to go from a life insurance policy to an annuity. You can go from a life insurance policy to another life insurance policy, or a life to an annuity. You cannot go from an annuity to a life insurance policy. So when you do a 1035 exchange from a life insurance policy to an annuity, your cost basis as well as your cash value carry over. So we had a situation here, and this was a female. She was 63. She bought an $8.5 million insurance policy, and she had $1 million of cost basis or premiums paid into the policy. The current surrender value was $192,000. So if she were to surrender the policy, which is what she was considering because there was no longer a need for the coverage, she would receive $192,000. The policy was funded as a 10 pay, so $100,000 a year for 10 years. Well, what we wanted to discuss with her is, instead of surrendering the policy and receiving $192,000, would there be a way that we could preserve her whole cost basis? And what would that look like? So what we explained is, if we do a 1035 exchange to an annuity, you could just let that $192,000 grow. And once the 192 grows back to $1 million, you could surrender that annuity and you wouldn't have any tax consequence, right? Because you're just recovering your original cost basis. And when you switch to an annuity, there's many different types of annuities you can go to. But in this case, we were looking at a variable annuity, and we were assuming a 6% growth rate. Well, you can imagine, to have 192,000 grow back to $1 million, it's going to take about 29 years. That's quite a long time in this case. But what we explained to the client is, if she had other assets sitting in a zero interest or low interest earning account, you could reposition those assets on top of this new annuity. So in the case of this client, she had $2 million of liquid assets that could be repositioned. And we showed, if you 1035 exchange to the annuity, and so you're carrying over 192,000, but then you add 2 million of additional premium on top, now your cost basis on the policy is 3 million. So you have 2.19 of cash and 3 million of cost basis. Well, at a 6% return, it would only take 6 years to recover that lost cost basis. And you can see here, After that period of time, you could surrender the annuity. And in this case, because the cash grew to 3.1, only 109,000 of that would be taxable. The $3 million is the cost basis, and so you got the return.
Real quick, it's not just low yielding assets. You could reposition other stock portfolios. Obviously, there are income tax consequences of surrendering or selling or disposing of a position, but it's just a matter of, if I have a place where I can have an asset grow completely income tax free, much like a Roth IRA, effectively, I've got this after-tax money going in. I'm able to use that non-deductible loss that if I just surrendered the policy, that non-deductible loss just goes away. If I 1035 exchange it, I transition that loss to the annuity. I can absorb all that loss through investment gains, have completely income tax-free investment gains, and then I could surrender the annuity, or I could keep it. We've had some clients that have chosen to continue to keep it because they have a charitable intent, and so we've 1035'd into a private placement variable annuity, so very low costs and commissions, no surrender charges. You have access to alternative asset classes, all kinds of things that are there of benefit. So again, regardless of the permanent decision that the client is looking to make on a portfolio, if there is a permanent decision that is going to be irrevocable, it would be a good idea to give Vince or myself or anybody at WealthPoint a call and say, here's my fact pattern. This is what the client is looking to do. And usually people view it as, I'm either going to keep or I'm going to quit. So I'm either going to keep it and continue to pay the premiums, or let the policy, in Ryan's scenario that he talked about earlier, just let it die. Not a good option. Just stop paying premiums and have it lapse before life expectancy. Great for the insurance company, horrible for the family group. Or I'm going to surrender it and take the cash value. There's a whole cadre of different strategies, life settlements not the least of which, that the client has access to that can enhance the value both to the family group and to potentially the grantor themselves.
So, in summary of everything that we've gone through today, we understand that our goal is for the advisors on this call to understand why life settlements should be considered, how it can help clients, where and when it fits. It can solve planning problems. Ultimately, it can be a better source of liquidity funds for clients who no longer want or need the existing portfolio. And there's a lot of other strategies that hopefully you've learned about today that you may have not considered previously. So, Ryan Brusca, any final thoughts or questions before we open it up to the Q&A?
Yeah, I mean, I think you guys said it perfectly. I think, life settlements aren't going to be the driver. I think life settlements are just an ancillary solution. I think, being mindful of where your clients are and how they're situated in their insurance holdings at any given time, I think is paramount. I think if you look into a life settlement and it's not the right path, you fast forward 3 to 5 years later, it may be the primary solution, right? It's not always going to be the driver. I just think it's part of the conversation and should always be part of the conversation. And I can't tell you how many situations we've reviewed in the past, and a few years later they come back. And I think that's the importance of life insurance. Clients value the insurance, they believe in the insurance, as do we. But at the end of the day, their needs are shifting, and there may be a better strategy out there. And I think WealthPoint can do a fantastic job of guiding you guys to the right options.
But thank you again for joining us. We look forward to our next edition, which we'll be announcing shortly. But again, Ryan Brusca, thank you so much for taking the time out of your day.
Great.
Thank you, everybody.
Thank you, guys.
Thank you.
Bye-bye.